This is the third webinar in a series of webinars brought to you by the team here at the Combined Authority of Cambridge and Peterborough. The first two you will be able to and can access online, and they were all about what support was available to you as a business, with various government grants and schemes, and then more detailed look at HR and some of the options available to you with your employees. So before we get started, I'd just like to talk to you a little bit about the scheme and what's available to you. Slide two. So yes, we're an advisory service, and we've been put in place specifically to help businesses across the combined area of Cambridgeshire and Peterborough through this COVID-19 crisis period. And we will be delivering a series of webinars over the next few weeks with very specific subjects and some fantastic subject matter experts making guest appearances to give you some really great advice on how to manage through the crisis. So you can see on the screen there we cover quite a large area, so plenty of businesses that can come in and make use of those services. So the sorts of expertise that we've got available to you, and we have a range of expert advisors. I'm just going to move the next slide on. So we can provide expert advice, as you can see, in a whole range of subjects, through from HR to import, export, sales, warehousing, and of course today more detailed look at accessing finance through this difficult time. So you are able to both attend the webinars, but also you can book a one-to-one session with one of our advisors, and I'll tell you about how you can do that at the end of this webinar. So without further ado, I am going to pass over to Richard Olson, who's going to host today, but we do have guest speakers with Jeff Greenfield and Richard Malchek providing us with some great expert advice. So Rich, I'll hand over to you for the rest of the webinar.
Thank you, Kate. Right, and thank you also to the panelists today. Richard Malchek from Pioneering Innovations is a specialist in UK grants and R&D matters, and Jeff Greenfield from IGF, who are one of the latest lenders to join the accredited CBIL scheme. So if I just talk through, obviously there was an announcement earlier this week, which wasn't a major surprise as it had been published mainly in the papers, about the new Bounceback scheme. It's a loan scheme that provides smaller businesses with loans of between £2,000 and £50,000. The government has offered a 100% guarantee against the outstanding balance of the finance, and there is no interest to pay for the first 12 months, nor are there any capital repayments. Additionally, there's no arrangement fees on it. And once once the application has been approved, payment should be received in a matter of days. They have said 24 hours, but let's give them a bit of leeway in that particular matter. Obviously, if you are already in receipt of a CBILS loan, then you have until the 4th of November to actually convert that loan through to a Bounceback loan, which potentially would save you the capital repayments during that period. So that's a nice little add-on. There is a requirement that you cannot have been classed as a business in difficulty as of the 31st of December 2019 if you're applying for borrowing of more than £30,000. Now, that is actually the same requirement that exists for both the CBILS and the larger CBILS scheme. And the business also has to self-certify that it has been affected by the pandemic itself. So this scheme is opening on Monday. The lenders were generally taken back by it in terms of the announcement because they were all expecting their level of funding to only be up to 25,000, so it seemed to caught them out slightly. So all their preparations were based on that. So as we say, that scheme should be up and running for Monday, and we want to see actually how that's going to be applied. But we'll talk a bit more about the guarantees, I think, as well during the course of this discussion. In terms of coronavirus business interruption scheme, this is for businesses that don't turn over more than £45 million. It's a £25,000 to £5 million facility limit, although we have seen lenders going below the £25,000. We expect most of that now to be picked up by the Bounceback scheme. The government guarantees 80% of the outstanding balance of the finance, and that means that in the event of default by the lender, by the borrower, the lender will try and recover the outstanding finance from the borrower. And if they're unable to do so, then they would recover the 80% from the government. There are no arrangement or guarantee fees for smaller businesses. There is 12 months interest-free repayments. You have terms of up to 6 years. For overdrafts and invoice finance facilities, it's up to 3 years. And you have unsecured lending up to £250,000 where there is no personal guarantees. For lending above £250,000, then the principal private residence of the borrower cannot be used as collateral, and the maximum that the lender can put down as personal guarantee is 20%. Important to remember that the borrower remains 100% liable for the debt regardless, and that's what I've just emphasised. Other things to consider. In terms of the borrowing itself, you must, from a borrowing proposal perspective, you must show that the business was viable for a lender prior to COVID-19, and the lender believes that the provision of finance will enable the business to trade again in the short to medium term. Information that is being requested from funders varies dramatically. Generally, there's 12-month cash flow projections. They will require your last filed accounts. They may require your management accounts since you filed your accounts if they're more than 12 months old. They may request your aged debtors and creditors reports. They want to know details of any other lending that you have in place, as it will come back to whether you can afford to repay the loans when eventually any repayment holidays have been passed. They all want to understand how you've been impacted by COVID-19. And in addition, if you are approaching a new lender, you will need to supply them with proof of address, passports, etc., so they can complete their AML checks. Lenders are prioritising their existing customers over new customers, and that does mean that a number of them are not taking on customers. As you have seen, there were originally 40 accredited lenders. That number has now risen to 52. Of the 52, there are 15 who are actually regional lenders. That means, and bear in mind the majority of the audience watching this are based in the Cambridgeshire, Greater Cambridgeshire and Greater Peterborough area. Those 15 lenders are not available in this particular area. Additionally, there's another 15 lenders who are not currently taking on new clients. Now, that's either a mixture of they don't have any they're not taking on new clients, and actually we have 3 who are not lending under the scheme, which is a bit bizarre considering they've been accredited. That ultimately brings your pool of potential new lenders down to something like 26 lenders in total. And of those, there are a number who are invoice discounters and asset finance lenders as well. So in terms of a straightforward commercial loan under CBILS, your pool is about 16 different companies or lenders available, which is quite interesting. Now, in terms of asset finance, if you are involved in manufacturing, for example, then generally you have plant and equipment. There is the opportunity under CBILS to look at refinancing that equipment and using a asset finance lender to sell your equipment to and effectively lease it back from. Additionally, invoice discounting is one of the other options that's available to you, and you can look at selling your debtor book effectively to the funder as well. You should, in the first instance, approach your existing bank stroke lender, as they already have a trading history with you. But at the same time, you might want to consider who else to approach, just in case. It isn't a quick process. It is getting better, but it's still not a quick process. But the more information you have to hand, the better informed you are in this process, the more likely you are to have your application processed quickly, which will enable you, hopefully, to achieve a successful conclusion. The banks are trying to help SMEs, but they are overwhelmed by the sheer volume of applications coming through. And as we've seen from some of the newer lenders coming on to the panel, it isn't a quick process to set up effectively a completely new funding line at a very short notice. The removal of the personal guarantees has made or appeared the process to be much quicker and slicker and open up to a lot more businesses. I think the reality is, however, is that businesses are sort of slightly misguided by this, because ultimately the banks are still underwriting the risk because they have the 20% share of the losses that may occur from a business. they still have to go through the typical credit process. And I'm sure in our discussions later on with Jeff, we'll be having his views on actually how CBILS will work in practice from an IGF standpoint and from the market as a whole. There's a couple of other things. And actually, I should have mentioned some Bounceback loan. The Bounceback loan, the maximum lending is 25% of your annual turnover. Generally, on the CBILS scheme, it's less than twice your annual wage bill for 2019 or your last completed financial year, or less than a quarter of your turnover as well, the last financial year. So there's quite a lot to take in there. If I move on to the large business interruption loan scheme, again, it's for businesses that turn over more than £45 million. It's up to £25 million loans available for businesses from 45 million up to 250 million. And if the turnover is more than 250 million, then they have the ability to borrow up to £50 million. Again, it's an 80% guarantee by the government. There's 12 months interest-free payments. The terms are up to 3 years only. And the same restrictions in terms of personal guarantees apply as before. It's currently, as it stands, there are only 10 approved or accredited suppliers of lending for that, which are the RBS Group, Barclays, HSBC, Lloyds, Bank of Scotland, Santander, Danske Bank, and Clydesdale/Yorkshire Bank. And as usual, the borrowing proposal needs to show whether the business would have been viable had it not been for the current pandemic, of which the lender believes the provision of finance will enable the business to trade out of any short-term and medium-term difficulty. They obviously have to self-certify that they were adversely impacted by the coronavirus, COVID-19, and they have not received a facility under the Bank of England's COVID corporate financing facility, which I'll briefly talk about. I know the majority of businesses we will be talking to are SMEs. However, the COVID corporate finance facility is a facility that allows the government to purchase sterling-denominated commercial paper, which has a maturity of between 1 week and 12 months. But it does require the business to have a credit rating from one of the major credit rating agencies of Standard & Poor's, Moody's, Fitch, DBRS, Morningstar. So I'm assuming that most of our audience actually aren't looking at that type of funding. Something else that was announced last week was the Coronavirus Future Fund. Now, this is quite interesting because this is aiming to support those businesses who are typically pre-profit, pre-revenue. But they are in existence. They aren't a dormant company. It's important to note that. It offers a convertible loan note scheme, which requires matched funding from private investors. There are a couple of requirements. They must have raised at least £250,000 in equity over the last 5 years and be unlisted. Loan sizes from 125 to 5 years, and the maximum term of the loan note is 3 years. They do convert to equity on the next qualifying or non-qualifying round at a 20% discount to the issue price at that time. And on expiry of the loan can be repaid with a redemption penalty. Now, just to give you an idea, the redemption penalty is actually 100% of the original loan amount, so it's a fairly significant redemption penalty, which is, I suppose, the incentive to actually convert it to equity at a minimum 20% discount, which appears to be the government's preferred route. So that's another interesting option. It is obviously in the current climate going to be challenging to find investors willing to actually look at putting in private equity at this moment in time, but there are still a number of funds around and angels who are looking at these opportunities and do see some real opportunities for businesses going forward. There is a lot of information around the outside of that particular scheme. Additionally, at the same time, the government announced that with respect to Innovate UK, that there would be £750 million available. UK Innovate would accelerate up to £200 million of grants and loan payments to its 2,500 existing Innovate UK customers on an opt-in basis. So that money is effectively ring-fenced for them. And an extra £550 million would be offered to existing customers in increased support, and up to £175,000 of support to around 1,200 firms who aren't currently non-recipients of Innovate UK funding. It'd be interesting to understand how that that second last bullet works in practice, and that would be an interesting question to get the view of Richard Malchek in a few minutes' time. First payments are expected mid-May, as the scheme is taking a little while to set up. Just some other things to consider in terms of financing. You could look at traditional finance. The banks and lenders are still open for traditional finance, although some have now completely converted across to CBILS. So you can look at a traditional overdraft, you can look at traditional commercial loan, asset finance, invoice financing. There's R&D tax credits available, and there's other capital grants available. So that, in essence, is the bulk of what we're here to talk about. So in terms of questions, I have some already, which are noted. Kate, if you pick up any which are coming through from the chat, I'd be grateful.
Yeah, we have got one come through, Rich.
Okay. Yeah, no, fine. If you want to go for it.
Yeah. So, question that's come through is: if your CBILS lender is not an accredited lender for Bounceback loans, can you still transfer across?
If they aren't accredited for Bounceback loans, then you won't be able to transfer it across. But the likelihood is that everybody who is an accredited CBILS lender will also be a Bounceback lender. However, Jeff, is that your view as well?
No, it's not my view. We won't be a Bounceback lender. We will only be a CBILS lender.
Yeah.
I think there's a separate application for Bounceback which you have to go through, and I think it depends on the typical profile of your clients as to whether or not you do apply to be a Bounceback lender or not.
Okay, and your typical clients are not in the category of the £2,000 to £50,000 loan lender, I'm presuming, or borrower rather.
Typically, yeah, correct. Typically our clients will be turning over anything from sort of 2 or 3 million up to 100 million, but most are in the range probably 5 to 25 million turnover.
Okay.
So therefore the requirement would be larger and fall more into the CBILS category.
Just regarding this whole piece around the 80% guarantee from the government, it does appear that SMEs generally are under the impression that this means that the banks have no risk as such. You know, you're getting 80% of your money back. This should be an easy process. How are you responding to that sort of comment?
We're just going back with exactly what you said earlier, Richard, in that the client is ultimately responsible for the repayment of the debt. The CBILS is just a scheme to help people out at the moment. Banks and finance providers have to go through their normal due diligence procedures. Nothing has changed. You've still got to underwrite the loan and look at serviceability and affordability in any case. It's just a case of, would it fit into the scheme? Has the business been affected, and therefore does it qualify to have a guarantee put in place by the government? If it does, great, it goes under CBILS. If it doesn't, then it's up to the lenders to choose whether they want to provide a loan to them or not. So it's still exactly the same underwriting criteria as per an ordinary loan.
Okay. And in terms of the 100% guarantee, I know you're not subscribing to that scheme, but if the 100% guarantee was moved to CBILS, what would change fundamentally from your standpoint?
I don't think there'd be any change. It wouldn't be as if money would just leave the building to clients willy-nilly. Still the same underwriting criteria applies. It's got to be a viable proposition. Lenders can't be lumping all responsibility.
Okay, that's interesting. Richard, just a question on Innovate UK grants. What is your view about, obviously, this new scheme that's been announced, and in terms of actually how customers are going to access this money?
Yeah, so my view is that this will feed through into the traditional Innovate UK competitions that are run on a regular basis. So it will feed through into programs like SMART, for example, where SMART offers grants of up to 70% of the cost of a project for game-changing innovations. And equally, it will feed into some of the thematic calls that Innovate UK runs. So they have some very specific themes that they follow that are in line with the government's industrial strategy. Things like autonomous vehicles and cyber security, areas of high tech that the government is keen to support in the UK.
Okay, so that's very much geared towards, I suppose, the point about customers who don't have, people who aren't currently customers of Innovate UK. But do you think that also applies to customers of Innovate UK today?
No, I think what's happening there is that Innovate is currently assessing the impact of COVID on existing projects.
Right.
So this impacts projects in a number of ways, some of which may be suspended because they're unable to continue. So, for example, if some of the partners involved in the Innovate projects have been furloughed, that project essentially is suspended until they come off furlough.
Yeah.
So it's possible that some of those projects will need to have extensions beyond their current term, and it could be that this funding has been identified, to support projects that might otherwise fall short of their full scope that they applied for.
Okay. So currently, are you going to see a whole load of new rounds of grant funding opportunities opening up, do you think, or will it just be more of the same?
That's already happening. So if you access the Innovate UK website, there is in fact new competitions starting to emerge. So it looks like it's business as usual at Innovate UK. For example, they've just recently announced the new competition that will open on Monday for civil aviation type projects. And clearly that's an industry that's heavily impacted by COVID, but innovation still has to continue. It will recover at some point, and clearly Innovate is keen to support civil aviation type projects.
And I suppose the question is, how is most of this money going to get out there? I mean, it's a competition, so it's a competition, there's winners and losers. So how can you make sure that more and more businesses are getting the money they need? Do you think the competition rules will be lax? Do you think the pool of potential winners will be increased?
I suspect the budgets will increase on some of the calls. So, for example, Smart has been running at about 100 million a year, and it could well be doubled, perhaps, for the year ahead, given that Innovate has more money to spend.
And am I right in thinking that with Innovate grants, you generally only get 2 bites of the cherry? If you're successful, great. If you're not successful, you have another attempt, and after that, there are no further opportunities as regards Innovate.
That's correct for the same project. Clearly, if the project is restructured or the scope is changed, then that's a new project. But for every application, it usually has 2 attempts. So if it doesn't pass in the first attempt, then the assessors provide feedback, and the applicant has got an opportunity to revise their application and resubmit it. But clearly, Innovate has to put a limit on how many times you can submit the same idea.
Yeah. And in that regard, do you think there's any possibility that Innovate might reapproach some of those companies who just missed out on a previous competition with monies?
I think generally they rely on applicants coming back and trying again in a future competition.
Okay.
Obviously, many of these applicants that are probably already engaging in R&D are also entitled, for example, to things like R&D tax credits. So it's not just limited to grants.
That's interesting. And Jeff, I appreciate you've only just started on your CBILS journey per se, but generally, how are you finding the marketplace in terms of the types of inquiries you're getting through?
So it's a very good question, Richard. We're getting 2 types of inquiry. We're getting the direct ones through the website, and we're getting those through our regular source of business, where sort of 99.9% comes from the professional advisory community. needless to say, those opportunities that are coming from the advisory community are much stronger and much more, in inverted commas, sensible opportunities. Those that are coming direct from the website are people who, in my experience alone, they don't appear to have looked at our criteria as to what constitutes them being eligible for a CBILS loan with IGF. So that they can be travel agents or retail shops, clients or businesses that we wouldn't ordinarily lend to. They have to have a receivable, debtor book for us to be able to lend to, and then consider a CBILS in addition. So they're clearly not looking at what constitutes an IGF deal. What that also tells me is that could be quite a bit of desperation out there from businesses who are making multiple applications to multiple lenders, just trying to get their hands on whatever money they can, and therefore not thinking about the consequences of taking on, an amount of debt.
Yeah. And in terms of your criteria, what is your criteria, for example?
Our criteria, first and foremost, for IGF, we're an asset-based lending company that focuses any facilities that we provide around a core invoice finance facility. The invoice finance facility has to be a minimum of circa £250,000, and if they don't meet the criteria to have an invoice finance facility from us, we can't provide any other facilities to them.
Okay. And are you seeing applications which you would traditionally have handled as what we call a traditional loan route as opposed to a CBILS route? Are you looking to, which way do you look to do, and how do you decide which one is a CBILS deal versus which one is a traditional route?
That's another very good question. The way I look at things is I always put CBILS to one side and look at what's in front of me. What is the opportunity? What does it look like? And if there is an opportunity to provide an invoice finance facility and a loan alongside it, if the answer is yes, I then go to the next stage: is do we write that as a regular cash flow loan alongside an invoice finance facility, or will it fit into the CBILS criteria? Okay. And that's the best way to look at things. So the opportunities that are coming through from the professional advisory community are pretty well thought out. They may also have had an application processed by their main bank as a first port of call and been declined. And this is something I'm seeing more often. And we've only been approved for a few days, but already I've seen applicants who have been declined by the bank for reasons that appear to be unfounded.
Okay. It's quite an interesting word, unfounded. So, yeah, can you give any examples of unfounded?
I say unfounded, probably a bit harsh, possibly the wrong word, but for example, I'm looking at something where in 1 year the business had revenue of about £5 or £6 million and had a very, very small loss, £2,000, and therefore was declined for a CBILS loan on that basis.
Yeah.
Whereas they're not looking at what we believe is, we would look at the overall position of the business, not just the historic financials. We'd look at the current run rates and the current impact of COVID-19 and what the future looks like before making a decision based on one single item.
Okay. And in terms of how you see CBILS fitting in, where do you see it in terms of the marketplace?
Well, if I speak first of all for IGF, I see it as a nice to have for IGF, and it's great to be accredited by the British Business Bank for it. Where do I see it? I potentially see it as it could cause issues later down the line. It could be kicking the can a bit further down the road. The businesses may get approved for under a CBILS loan, and then they may not come through the other side of this pandemic. They may not achieve the sales and therefore resultant profitability in order to repay these loans once the capital element is once the interest is starts to be repaid. So I think there's potentially more problems looming further down the line. I think it's a good solution, and it's a good type of solution for the immediate need. Whether it addresses all the needs of the SME, I'm not entirely sure.
Yeah, and probably
I'd be interested to hear what others had to say on that on the call.
Yeah, I suppose, and the other point is the 100% Bounceback loan scheme is probably creates that, or makes that issue even larger potentially, doesn't it?
It does, and one of the great difficulties, and one of the things that will come out, and it won't be now, but it will be in the fullness of time when, and it will be a case of when, not if, but when people start defaulting on these in the future. The British Business Bank will then be tracking back through the audit trail, looking to ensure eligibility has been adhered to, and that the lenders aren't just, as we referred to earlier, they're not just handing out loans willy-nilly without the due underwriting. And this is what the end client needs to realise, is that they're still being underwritten for a loan, and therefore banks have the right to decline a loan, and as do independent financial providers. They have the right to decline it based on their lending criteria. Yeah,
absolutely. And just a couple of other areas. I mean, there's a number of sectors which obviously exclude, banks, insurance, and a couple others. But are you seeing CBILS being used for acquisitions at all?
I think there's a bit of conflicting information in this respect. I believe there will be opportunities that will come about from this pandemic, which will give rise to acquisition opportunities, and therefore a business can and should be able to be considered for a CBILS loan, for an acquisition. I do believe, I may be slightly incorrect. I know there's a very unwieldy document about eligibility, etc. But I do believe that acquisitions are eligible.
Right. Yeah, I have to admit, it does seem to be a bit of a grey area, that whole piece.
You've also got to consider at this moment, if anybody is considering an acquisition, how are they valuing the business? On what basis are they valuing it? Historic, current, future? It's a minefield, and for anybody who's looking to do any sort of transaction, I'd say good luck to them. I spend a lot of time dealing with the corporate finance community and accountants, and pretty much all of the transactions that I was working on in the run-up to lockdown have all been put on hold. I don't believe there's anyone brave enough to take on a transaction at this moment in time, not that I've seen.
There appears to be a number of people who are talking about transactions. They're not necessarily looking to complete on transactions until after the pandemic is over, but it definitely does seem to be something happening. The other thing with CBILS is, again, it's something that doesn't seem to get any real press about, is the fact that you can't use it to pay down existing loans. So, some companies say, well, great opportunity, I could take the CBILS loan on and I can basically pay down an existing loan that I've already got. And that is I believe, one of the things on CBILS that you can't do. Is that correct?
100% correct. It's if you think about where CBILS has come from, it's using the platform of an EFG, the Enterprise Finance Guarantee, and that can't be used to consolidate or repay old debts. And if you think about it, if you'd for any other loans that you may have, or that a business may have, where security has been pledged, it would almost takes away that security and it gives it back to the client, and therefore puts the banks and finance houses in a less secure position. So I agree that there's no way it should be allowed to be used to refinance any existing borrowings.
I don't know how that's going to be policed in practice, though. So, I mean, that's a slightly different issue. I'm not sure how, unless it's a stipulation within the agreement that's signed with the client. I don't know how anybody's going to police that particular issue.
I think you raise a very good point there, Richard. How does it get policed? It's you're right, it is open to abuse, but you've got to think that we're in troubled times, and hopefully you'd expect SME to be sensible.
Yeah, no, absolutely. I think there's some really interesting things that may or may not occur as a result of CBILS. I'm aware of one lender at the moment who is requiring that if a borrower does get a CBILS loan from its existing bank, that they are basically their lending is placed ahead of the CBILS lending. And I believe that it's being turned down by the banks as a result of it. So that's requiring the banks to decline it, which is quite an interesting stance they're taking, and could create some real issues for the marketplace, because if you can go and borrow the money elsewhere, that business, that lender is actually a CBILS lender itself, but is limiting the amount of lending it is willing to do. It's creating a very big problem for businesses when they're actually being recommended to go to their current bank first to actually borrow the money. I don't know if you have a view on that particular issue, but it is quite a challenge, I think.
I think more of an issue that we're finding is where you have invoice finance providers who are non-CBILS approved.
Yeah.
People who have maybe just taken out a facility in the 6 months running up to COVID-19, and they now need some additional help. They would have paid and gone through a little bit of pain and business interruption to transfer from one lender to another. And now they're trying to access CBILS. They go to their existing provider or bank and they say no, and then they have to switch to an invoice finance or consider an invoice finance provider who can offer a CBILS as well. And I think it is quite a grey area, as you say, Richard.
Yeah, I think it's very interesting. Okay, well, I think that's it on the question front. Kate, have we got any more questions? Not that I've seen come up.
I think just no more have come up from our attendees, but just a couple for me that have come up, I guess, while I've been listening to you. I'm not from the finance industry, and so I guess thoughts from me are, I guess if you were an organisation that would normally be accessing financing, you would be preparing for that. And I guess there are so many organisations out there currently that have been caught relatively unaware with the current crisis. So I guess if you were giving some advice, any of our panelists, to organisations who were considering accessing financing, what could they do to be preparing themselves to access that financing, bearing in mind you don't want them to make a knee-jerk reaction, as Jeff said, fall foul later when the business may not be sustainable. So what can businesses potentially be doing?
Well, I'm going to pass this one to Jeff nicely, because I think it's better hearing from a lender rather than from me personally.
Thanks, Richard. It's a really good question, and first and foremost, I think businesses need to, take the time. It doesn't have to be done today. It can be tomorrow. Being prepared and having a very comprehensive pack of information to provide to a lender will help greatly. What I mean by comprehensive pack is, under normal circumstances, lenders want to know what's the story of the business, what's the background, who are the management team, tell me about your historic financial performance, and what is it that you do. And that's a given for any finance provider. Then what's more paramount than all of that is, how has COVID-19 affected you? So what have you put in place? Give a comprehensive plan or an exec summary of what has happened to staff. Have you furloughed them? Have you taken advantage of the staff retention scheme? Number two, what's the how have your customers reacted to this? Is there a domino effect? Are they falling over? Are they taking longer to pay? What about the supply chain? Are they giving you any support? Are they extending terms to you? Are they putting pressure on you? HMRC. So just going down each of the points that any business owner would be thinking about right now: its customers, its suppliers, and its banking relationships. Tell me about what is happening. And if they give that as a brief overview, as a lead in to the background to the business, that's exactly what a finance provider is going to look at. And any business that hasn't got that information or doesn't prepare that information is going to find it very difficult to access any type of funding at the present time. They're being prepared and taking a little bit longer to ensure that what they're presenting to the finance provider is sensible and logical, will really help when potential facilities are being underwritten.
I guess, and that's a really good answer, thank you very much, because I guess it is this piece around slowing down to speed up and making sure that you've got absolutely all the information and advice available to you, because I mean, certainly from my point of view, sitting and listening, there's just so much out there to take on board, it can be really difficult to understand everything. I do have a quick question for Richard. I think one of the things where Richard Bounceback, that is, one of the things I'm hearing a lot about is pivoting. So if you were thinking about pivoting your business now and diversifying, what are some of the things you could be putting in place to make yourself, I guess, most desirable for any access to any grant funding?
Yeah, that's really interesting, Kate, because that's exactly what some businesses are doing. They've spotted the opportunity and identified a need in the market that perhaps wasn't there until COVID arrived, and are repositioning themselves to take advantage of it. So clearly, just recently, Innovate ran a competition, which was actually 100% grant funded, which is exceptional in grant terms, as normal grants are normally match funded in some way. But they ran a competition for COVID disruption technologies. And it's interesting to see the sort of things that will come forward for that kind of thing. So things like, assisting businesses with remote working, resolving some of the issues about educating children while they're at home, for example. All those sorts of ideas are ideal and could still be fed forward into some of the smart grants that are looking for game-changing innovations. They are by nature game-changing. I hope that answers your question, Kay.
No, it is. It's fascinating, isn't it, to think about how you can both use the access to financing to think about reacting to some of your business needs, but also being proactive right now and thinking about how you can diversify.
Indeed.
Yeah. There's no more questions, which I think one you've picked up and answered, haven't you? So one that came through to say, can you pay off existing finance with the Bounceback loans? I think that may well have already been answered, I'm not sure.
Yeah. Okay, so Kate, just to wrap up, I guess.
Yes, so well, that's been an absolutely fascinating session, certainly from my point of view, where I'm not financially minded as my number one area of expertise. It's been fascinating to hear about not just what's available, but also your take on how to interpret that and what's going on right now, because we're all stuck in our own little worlds, aren't we? So can I just say thank you to Richard Olson for hosting that session, and to Richard Bounceback and to Jeff Greenfield for providing their expert advice. So as we said, we are delivering a series of webinars. The next webinar is next Tuesday, the 5th of May at 11 o'clock. And that is a webinar covering working from home, employee wellbeing and mental health. I'll be hosting that with a guest speaker. And beyond that, I think on Thursday, our next webinar is marketing and crisis comms. And then we've got 2 or 3 beyond that booked in. So I would recommend that you get onto the website, have a look at the seminars that are available to you, because there's lots of great information that you can tap into. Alternatively, and one of the things that certainly is clear to me this morning is how much there is to consider and how important good advice is going to be right now to you in terms of making the right decisions. So if you would like to get in touch today for a one-to-one session, you can see the appropriate website address there, or you can email us at support@cpcabusinesssupport.co.uk. So it just remains for me to say thank you for coming along to the webinar this morning, and please do stay safe. Thank you very much.